Good morning and welcome along to another episode of Beyond Bitcoin. My name is Derek Graham. I'm here today with my friend and colleague visiting us today, Nitin Gower. Welcome along. Great to see you, Nitin.
Hey, Derek. Really glad to be here. I actually missed it. I've been heads down on 100 different things and happy to share some of that stuff. But so good to see you. So good to be back in the element. And I was looking forward to this. So thank you for having me on your podcast, which used to be ours, but now it's yours.
Nitin, it'll always be partly your podcast. It's such a big part that you're here. Hey, Nitin, interesting week. Always is an interesting week. But of course, this week we saw the European Central Bank drop 25 basis points with the interest rate, which was intriguing. We've seen Bitcoin bounce around that up to about that 68,000 US dollar level. And that's seen inflows into the ETFs of some 1.7 billion or 1.2 billion rather over the last couple of weeks. But what's interesting is Ethereum's ETF has seen 28 million, a tiny fraction, go into Ethereum during the same period of time. Maybe we should have a discussion about what's happening with these layer one protocols, these blockchains.
Yeah, no, absolutely. And so two things on this. If you look at the ETF wrapper, which is the financialization of crypto industry to traditional finance, giving exposure to the likes of the asset owners, the pension funds, the hedge funds, and so on and so forth, gives them an avenue for them to own in the space. And Bitcoin did exceptionally well. It continues to do exceptionally well, largely with what has happened with BlackRock and Fidelities of the world, made it accessible. I personally have experimented. It's really easy. It's literally 2 clicks to actually own a piece of history and a piece of that movement that's happening and provide exposure in a regulated, compliant manner. Of course, it has its own fee structures because now you have financial institutions involved. But there's one thing, Derek, when you look into risk model frameworks, and most people don't understand this, and that includes Portal. When we started out Portal, as we had risk model framework, we had a framework where we look into the upside, the downside of an asset, and how do you value an asset. So the valuation metrics were simple and easy for Bitcoin because Bitcoin was an asset, and the narratives were that it's a store of value and it has a few other things. I think Ethereum is overly complicated. And actually, I was discussing somebody else with the crypto Twitter ecosystem. I spent close to about 60 to 100 different hours as I'm exploring my existing venture in what does it mean? What is the trading avenues? And I spent 60 plus hours, and I've been in this space for quite a long time, as have you, that today, if somebody enters the Ethereum ecosystem, it takes a PhD to understand the layer one, the layer two, the DEXs, the liquidity pools, not just the staking, which is post-merger from proof of work to proof of stake, but now you have liquid restaking tokens, and you have the MEV, which is minor extractable value marketplaces. You have validator marketplaces. The question is, you have to understand the economic linkages between all these different ecosystems, which makes it complicated. And I believe that in absence of simplicity of an instrument, what gives it value, which is easily discernible for Bitcoin, I think Ethereum became victim of its own success, of that massive innovation growth that it enjoyed for the longest period of time. And we begin to see the rise of Solana because Solana doesn't have the burden of that complexity yet. It still has thwarted the layer two conversations. It has said, look, we're going to get your exchanges, the marketplaces, you bring your assets, we're going to have DeFi protocols. And what's amazing this time is Solana, the DEX volumes has seen 50 to 100% growth in 12 months. And the same is not true for Ethereum. It's still in triple digits growth. And I think that's the primary driver that when it comes to financial institutions and large financial institutions, where you have mathematicians and you have quants and you have mathematical models, the valuation becomes a challenge to how do you value these things, that even a 15 basis point change in valuation changes the calculus for a large pension fund, which is aiming to invest billions into the space. So I'll pause here. I'd love to get your perspective. That is my take on this, that it's enormously complicated. And I think that it's now hurting the ecosystem, which was great from a narrative, from an innovation narrative perspective, but not great from investment narrative perspective, I think.
Yeah. So interesting. So firstly, how lovely is it to have you back? I've forgotten how fast you speak.
I got excited. You triggered me.
One of the things you said there is that Solana had increased by 5,200%, not 50 to 100%, but by 5,200%. It's a massively fast rise. And so what we often think about in this sort of legacy world of consideration is we look at the giants, those that have dominated the globe in a particular sector, such as Apple, or obviously such as Amazon, or such as Facebook, and we consider how difficult it is to dethrone them from their position.
Yeah.
And then we look at Solana and Ethereum and realize it's not the same in this world. You can dethrone a giant fast. And it's really quite intriguing to see what's happening with the massive onboarding of PayPal, Visa, MasterCard, all onto a simpler outcome of a Solana chain. So it does grow and change very differently, doesn't it?
So I think you bring a really brilliant point, Derek, that displacing, I used to work for IBM, and IBM used to be at its zenith, the top tech, and you don't hear about IBM as much anymore because you have Apple, you have Google, you have now Tesla, which is trying to. So the landscape of technology has really been complicated, of this newer comers with massive valuations and enormous access to technology in general. And I've been in those conversations in the infrastructure that's needed. But in this context of displacing the giant, which is what you mentioned, I think it's such a critical point, Derek, because if you look at what happened in November 22, what happened in November 2022? FTX, this is the contagion of incompetence, as we have labeled it.
Yes.
3AC, Celsius, FTX, looked what the whole crypto house is burning. And Solana was written off. This was just almost about 2 years ago. And in 2 years, Solana came roaring back, displaced Ethereum. So I think that the speed at which the industry is moving is incomprehensible to your analogy of the old crypto world, that it's hard to displace. Apple it took Apple of almost 6 to 8 years to displace BlackBerry, which was the previous phone giant. And it's going to take OpenAI, I would say, another 3 or 4 years to displace many of its sort of areas. And it's crafting its own narrative from an AI perspective. And same with NVIDIA. But this is unprecedented. 2 years. And seen that level of growth, which to me is something to research about as to why and who are the other players. Because I've been working with Cadena as, for example, a dormant layer one. I've been looking at SEI network, SEI network, which is institutional grade, Polymesh. I've been working with Polymesh and Solana in my own adventure as I'm looking at this, and some amazing tech. And some of these names were not household names 2 years back or even 6 months back, but they now suddenly begin to pop up. So good point, Derek, on that.
So one of the things then is that if we look at these major layer one protocols, with the exception of the specialist layer one protocols you're talking about there, maybe institutional grade, peculiar and specialist to a particular area, but these major layer one protocols are ultimately going to be the transaction layer of all of which is built upon it, which we've often talked about before, the various stacks that sit on top of this. And we've consistently said that it'll ultimately, whoever it is dominates, whatever dominance is going to be there, it'll become essentially commoditized. And so probably the price earnings ratio, or the revenue to price ratio, by example, will start to flatten out as it becomes commoditized. Right now, as an investor, when we look at this, we look at Ethereum, and broadly Ethereum generates maybe $10 billion per annum. And it's capitalized today at about $301 or $2 billion. Yeah. So that's a 30 to 1 revenue ratio, not net profit, revenue ratio. Okay. Yeah. So look, these things don't dominate how investment's done in this space at the moment, but they're indicative. And then you look at some of the layer 3 protocols or DeFi protocols and the layer 4 protocols, which are the Web 3.0 applications. These are apps, they're applications. Aave is generating $766 million return on about a 2.3 billion cap. Let me just have a look at it there. And what that indicates, yes, those are the numbers, is that indicates a multiple of 3, not 30. Yeah. And so it's starting to make you think there are some much better multiples sitting in apps than there are in layer 1 protocols. What do you think?
First of all, great job in articulating the layer 1, layer 2, layer 3, layer 4. I think there's still that impeding conversation in the industry from that perspective. Great point, Derek. And so two things to this, right? One is the perceived value of layer 1 tokens was, at the end of the day, some of the imminent thesis around layer 1s were scarcity, that if a protocol or a network becomes ubiquitous, then its token becomes valuable because everybody would want that token so it can process transactions and participate in that ecosystem. So if you have a business, and we compared layer 1 on this podcast in the past, Eric, to nation state status, that it's going to attract capital,
Yes.
talent, projects all around the world.
Yes.
And this is what I meant by the parasitic approach of layer 2s. There are so many layer 2s that have popped up on Ethereum. The intentions were great, that yes, we want to solve for scalability, we want to solve for security, we want to have Uniswap announces layer 2 on Ethereum, and Ethereum itself is now Vitalik's recent assertion that we want to go to 100,000 transactions per second with some rollups. So these are all narratives which is going towards the fact that can we make it abundant and cheap. So your traditional PE, price to earning ratio, which was essentially how much are you willing to pay for a stock based on its earnings. So for every $1 earned, how much are you willing to pay? And generally that litmus test, if I recall from my traditional finance days, 20 was a good number because you're not paying for how much they earn today. You're paying for its potential in future of the price earning and the earning trajectory of an enterprise. And in case of Ethereum, the goal was simple, that if Ethereum begins to start handling transactions from the 8 billion plus people and a million different projects, then no matter how much layer 2 grows, they eventually be used with Ethereum as a global state of every transaction. And that will really continue to make it valuable. Except that they didn't count on the growth of parallel and adjacent Solanas, and Avalanche actually has a conference in Buenos Aires this week, in attracting the same talent and capital that Ethereum had the privilege. So Ethereum was the incumbent leader, and to me, it's the entity that actually has more to lose because it had all the ecosystem players in it. I think we see some of that stuff moving towards that model, but I wouldn't go with this. Like, I would say that Ethereum has a long way to go, and that is another calculus, Derek, that you mentioned, which is going into the traditional finance in the ETF space and say, why hasn't money flown into Ethereum? And that's one of the calculus that is contributing to it, I think.
We always had this discussion, price versus value, right? So
That's right.
The price of Ethereum may well drop. However, the value that Ethereum is and will continue to create for this industry, and along with Solana and others, is immense because it is the foundation of everything that the industry does. And it's been building out there, preparing for layer 2, layer 3, and layer 4, ultimately being Web 3.0. It's been building that out for some number of years. We as investors might look at this and say, we're not quite sure about what the price is going to do with Ethereum over a period of time. And there may be a price fight. In other words, there might be better performance price-wise and even for volume turnover of Solana over a period of time. But value-wise, both of them are creating these incredible transactional layers that enable the future of Web 3.0 occurring. And at Token 2049, we did have this discussion around venture capitalists, that all the VCs got on the stage. I think your friend Scaramucci was on the stage too, bless him. And he was talking about, apart from politics, which is always colourful, they were talking about where the venture capitalists are investing and where they're not. And they won't investing and won't recommending to invest any longer in the layer 1, layer 2 protocols, because they said it's thoroughly supported, it's thoroughly funded, and there's enough in the marketplace already. And they're moved up to invest in layer 3 and layer 4, Web 3.0 apps. And all, 4 of them on the stage agreed, which was really quite intriguing.
Interesting. So I differ, and I love Anthony. Every time you meet Anthony Scaramucci in these events, very personable. And I told him you should go back into politics because every time he meets you, you're the most important guy to him, which is a great characteristic in anybody else. And I think 2 things to this, right? One is that there is still seen a lot of inflows in many new layer ones, especially in Bitcoin layer 2 ecosystem, has seen a growth this year where several $billion has been invested into it. So I think the investment continues. But I'll say this, Derek, that I've said this, price is what you pay, value is what you get, as we've said this. And technology is deflationary. So the fact that I can eventually cut and paste and derive, and everything is open source driven, and you can still have some amazing technologists who can come and change, whether it's zero knowledge proofs or whether it's quantum proof cryptography that drives this security of this infrastructure, or looking into utilizing the new and emerging chipsets and interconnect innovation that AI is already doing because they have to move data at a much faster pace. Technology is deflationary. And I think that over time, layer 1, layer 2 becomes pure commodity. I think that's where he was heading, as to the investment calculus from a VC perspective should factor that in. And I was at Token 2049 too. I think his thinking was, as a VC and as a fund, he's looking at 50x, 100x multiples. And over time, layer 1, layer 2 may not be able to deliver that, but certainly the Aaves and Uniswaps and the DEXs will, because they are bringing the utilization of the underlying technology in a meaningful way and collecting a fee. So that rent collection is the growth trajectory, I think, is what he was referring to. I share some of that perspective, but I still think there's a lot of investment gone into especially the liquidity. Bitcoin market cap is almost 2/3 now, 1.32 trillion of the overall 2.4 trillion market cap. And if that liquidity is still confined to Bitcoin ecosystem, how do we move that liquidity from here to Solana, Ethereum, and utilize the value of which is trapped in Bitcoin? And Bitcoin itself is fighting for its own DeFi, as you've seen with BitVM innovation and the DeFi protocols and Bitcoin ecosystem. And I think that's an important innovation, that is ability for us. And this goes back to the age-old problem, which still we haven't solved, is interoperability. How do I move liquidity from Bitcoin to other ecosystem like Ethereum and Solana, which has much more advanced DeFi ecosystem, without counterparty risk, without the risk of permanent loss of assets? I think that's an innovation that we need to invest more into than more layer 1, layer 2. I think my read of his assertion was that, if that makes sense.
And the more and more I progress with constantly looking at the various technologies and tokens that reflect their utilities, the more I'm convinced that Bitcoin is just standalone. It's becoming virtually an asset on its own. It's getting invested in by groups, organizations, and governments that wouldn't otherwise invest in an alternative token or a DPIN token or a sci-fi token, etc., these different classes of dApps, digital applications. It is just, it's becoming really, or maybe it's been there for a while and I just haven't recognized it. It's just a standalone asset. And I think we're going to start looking at it differently, progressively, as just a standalone asset. Yes, we'll always do calculations maybe between the ratio between Bitcoin and Ethereum, or the percentage of the total capitalization of the asset class to Bitcoin. Or maybe we won't. Maybe we'll get to a point where we're going, that's the digital asset class and here's Bitcoin. I do think they're quite different now. But at any rate, all that represents opportunity, and it's fascinating to see this kind of legacy world of ETFs taking a bigger and bigger position. It is a legacy. It's a legacy way of investing. If you know how to buy a Bitcoin and put it in a wallet, you do that instead and pay no fees. So it's a legacy. I hate to be harsh, Larry, but it's a legacy world that creating, or massive on-ramps into this space. But it doesn't stop being exciting. Love looking at what's happening with AI, have done for a while. Love looking at what's happening with DPIN. So much of that discussion was occurring at Token 2049. Yeah. And of course, this ongoing, what you and I nickname, particularly I've said, the world's greatest reverse takeover in history, and that is the digitization of traditional assets. It's not possible for me to lose much more hair, but I think by the time all of this runs through, I'll have a lot less hair than I do now. There's so much coming. Read the bull market. Interesting, one last comment there. A lot of the commentators are saying it's within the next 14 days. So that'll be intriguing. It's the 17th of October when we record this. Yeah, well, maybe we'll catch up in 2 weeks' time and see whether that bull
We do
market
that,
has really
yeah.
started. Yeah.
So 2 more points, I think, for the audience is, one is to your point, Derek, that yes, and I hope Larry Finkel is listening to this, or we'll probably send a podcast to him as a gift from Beyond Bitcoin team.
Of course.
But the overall institutional growth, I think there was a whole element that a bunch of Asia-based private wealth managers are seeking investment. It's largely family offices and HNIs, the high net worth individuals, into this asset class. So there's a constant inflow of that coming into this. But
Yes.
more importantly, you begin to see the MicroStrategy playbook coming to life with the likes of MetaPlanet, which was basically a hotel chain trying to use Bitcoin and take the same element. And again, now there's a new thing around the fact that is MicroStrategy actually helping or is making Bitcoin worse because they're just hoarding onto it and deal with this thing. And let's say one last nugget, which was significant for me this week, is stablecoins. Stablecoin by far is provided the most amount of value, not just payment ecosystem, but you look into PayPal, BUSD has reached $1 billion market value. So within the last 4 weeks, $1 billion have been poured into it. PayPal is now using its own stablecoin for its venture investments and merchant payments. Visa is going to help institutions like banks to issue fiat-backed tokens on Ethereum. And Stripe is trying to buy a stablecoin platform, a bridge. And so all this to me simply means that the tokenization of the settlement instruments, cash, is well underway. Now it's just a matter of time that we switch from using stablecoin as payment instrument, which is me paying Derek, to settling securities in hundreds of millions of dollars because there's enough market depth in stablecoin. And that just changes the narrative and puts this industry on its head to say, we've tokenized money. Now let's go and tokenize the asset because now we can go after instant settlement,
Yes.
which is still not there. I think that is
Yeah.
significant from a real world asset, and this reverse takeover, as you put it, Derek, that is significant from my vantage point.
Yeah,
I think.
No, I totally agree. Hey, good time to be alive. Thank you for joining us. It's been awesome to have you back, and look forward to
Likewise,
catching
Derek.
up with you for in a few weeks' time. Let's see whether that few weeks is going to be what we think these experts are saying, which is the beginning of the bull run in that regard. And yeah, let's keep an eye on Bitcoin and see how it really does perform separately, possibly, to the rest of this marketplace. We're not going to become Bitcoin maximalists. There's no red glowing eyes here. It's just that
No.
it's really interesting how it operates. That's all.
We are pragmatists. And when you say, Derek, what do experts say? I think me and you both are experts. We spend enough time. You founded a hedge fund in that context, and you've been studying this industry for quite some time.
Yes.
So I think we both officially are experts. So we joined that select group of people.
Gosh,
I think.
we'll have to
But
put
good
the
to see you,
word
Derek.
other in then. All right, great for that. Bye for now, Nitin.
All right. Take care. Good chatting. Bye.